All right, we will go ahead and get started, and as people join, I'll go ahead and let everyone in. So today we're going to be talking about credit score myths. So some of the common myths that go around on the internet that you may hear from friends or family or whomever out there. So I'll introduce myself first, and then we'll go ahead and get into today's topics. My name is Ivory Becker. I am the owner of Insight Strategies Credit Repair. We help our clients to repair their credit from a place of credit damage. Many of our clients have come from a place where they may or may not have come through some sort of a hardship. So a lot of our clients have had something like a medical bill, or they may have had a time of unemployment or anything of the sort, right? We all go through something in life that keeps us from sometimes being able to take care of our obligations. So bear with me here, my computer froze. Let's go ahead and I'll bring up the slideshow again. All right. Okay, there we are. So by the end of 2021, we were able to successfully remove 7,594 negative accounts from our clients' credit reports. And one of our main goals here is not just to help with credit repair, but we also enjoy providing educational information and a path to overall financial freedom when it comes to the services that we offer our clients. So we do offer quite a few webinars. At the minimum, we do one webinar a month, but we try to do about 2 webinars per month. So feel free to stay tuned and check out our Eventbrite page. That does have a lot of our upcoming webinars. We still have many more to be posting for later on this year, but we can send you the details on that as we go as well. So today's topics, as far as what we're going to myth bust: paying off auto loans early helps my credit score, right? Checking my credit score lowers my score. Paying collections raises my credit score. I need to use my credit cards monthly to raise my credit score. And inquiries are severely damaging to my score. So we'll take a look at all of those topics. Oh, and I did forget to mention, if you have questions throughout today's webinar, please feel free to either type them in the chat or just go ahead and unmute yourself and you can ask those questions at your leisure. I do want this to be interactive, so any questions you have, feel free to bring them up along the way. All right. So with that, we will go ahead and we will get started. So before we get into the specific myths, I wanted to take an opportunity to look at the credit score algorithm. So what are the key components that create your credit score? Now, credit score is essentially a risk management tool. It is meant to essentially determine what is the likelihood that you can maintain your obligation to a creditor. So really that number anywhere from that 300 to that 800 or 850, depending on the bureau, is meant to say, if my credit score is higher, that means I'm low risk to having a past due payment or defaulting on that obligation. So the biggest overall factor contributing to your credit score is payment history. So right here, you see this payment history. This is going to include anything that has to do with a collection account, any charged off credit cards, any late payments, anywhere from 30 days going on. The further past due that payment, the more of an impact it's going to have negatively towards your credit score. The second overall factor is the utilization ratio is a better way of putting this. So the amount you owe versus your credit limit. So that's 30% of your credit score. So utilization is a factor that's often overlooked. If you are an individual who's experienced credit damage at some point in your life, you may be afraid of having a credit card. If you're ignoring this category and you have no open lines of credit, which would be a credit card, any sort of revolving debt, this could mean you're limiting your credit increase potential because there's no way to impact this category if you don't have any established lines of credit. The third one is length of credit, which really just means credit, how long have you had your accounts open? So the average age of your accounts is factored into your credit score, and you're rewarded for having accounts open for a longer period of time. So again, things like credit cards, where you don't have to maintain a balance, can help to positively influence that category and elongate that average age of your accounts on your report. New credit is that next section. So new credit really covers how new are your accounts. So similar to length of credit, but it's also going to look at inquiries. So specifically, it's concentrating on brand new accounts within the last 12 to 18 months. So you get a little bit of a negative weighting from that, but inquiries is that other factor. If you have quite an excessive amount of inquiries, you may see an impact in this category to your score. And lastly, we have types of credit used. This is really just credit mix is what I like to call it. So all that is looking at is what type of obligations do you have on your credit report? Do you only have credit cards? Do you have no history of auto loans or mortgages or any types of other debt? You're rewarded for having different types of debt and being able to successfully take care of those obligations. So that's the credit score algorithm. If you're interested in really getting in depth on this algorithm, we do hold quite a few webinars exploring each of these categories in more depth. So I encourage you to join one of those webinars as well. All right, so let's get into the very first myth. So paying off auto loans early helps my credit, right? Wrong. So paying off an auto loan, there's a common misconception that the credit utilization ratio will be impacted when you pay off this auto loan, meaning most people liken it to a credit card. When you pay your balance off with a credit card, you see your credit score increase. Unfortunately, that's not the same with an auto loan. So an auto loan, when you pay it off early, it's going to reduce that average age of the accounts that you have on your credit report. So an individual that may be impacted more severely in this category would be someone with what we call a thin credit file. So a thin credit file is a credit report that has minimal account history. Maybe you're new to establishing credit, or you don't have a lot of accounts that are currently open. Maybe most of your credit history is all closed accounts that are quite a bit old at this point. You're going to be more adversely impacted by closing the auto loan because there's just not a lot of cushion that exists on your credit report. Similarly, this is also going to adjust that credit mix category. So if you recall, credit mix is that bottom section here, 10% of your credit score. If this was the only type of installment loan that you had on your credit report, and you've now removed that or closed that account, you may see a drop in your credit score because of that. So just to clarify, in case anyone's not familiar with the term installment loan, it really means any type of a loan where you're given a set amount and a set payment schedule. So by the end of your payment term, that account is paid off. So accounts that fall into this category are, of course, auto loans, mortgages, a personal loan as well. A debt consolidation loan would fall into that category as well. So if you're removing that installment debt from your credit report by closing that account, you may see a small impact in your score because it is impacting that credit mix category. Additionally, if you've been working to raise your credit score, removing this type of account from your credit report removes the future potential of adding good positive history to your credit score, right? Payment history, again, is 35% of your credit score, so it is that biggest overall factor. So when we remove this account, now we're removing the possibility of reestablishing good credit and showing future creditors that you have the ability to make on-time payments. So you may be wondering how this impacts you if you have a high interest rate. If you have the opportunity to refinance your loan into a lower interest rate, that would be a good choice if you are working to rebuild your credit. And sometimes when it comes to credit rebuilding, you end up trading off paying interest to increase your credit score. And it kind of has to be a concession that you end up making, because in some ways you have to rebuild that history. You have to show that you have the ability to make payments, and that means you have to have items on your credit report in order to show that. So this advice itself doesn't replace any advice specific to your credit report. So always make sure, if you're in a situation where you cannot afford to make that monthly payment, it doesn't make sense to keep the auto loan. If you have the ability, let's say you came into some funds and you have the one-time ability to pay it off, but not satisfy a monthly obligation. So do what makes sense for you in your financial situation, because ultimately, if you can't afford your monthly payments, you have to do something about it. Alrighty, let's move on to myth number 2. Checking my credit score lowers my score. So this is another myth. Checking your credit score yourself does not have any negative impact on your credit report. Any sort of a credit monitoring service is not considered an inquiry. It is considered educational. You won't even see on your credit report that you pulled your own credit. And it's not necessarily a pull, but that you reviewed your own credit. It is important as well to keep in mind that not all credit monitoring services are created equal. So what do I mean by that? Many people use services like Credit Karma or Credit Sesame. Now, those services are good for knowing what information is on your credit report, but they are not going to give you your credit score, your true FICO credit score. So services like Credit Karma and any of those free services, they are what's called a Vantage score. A Vantage score was created in 2006. And it was actually created by the bureaus. But it's not a score that any lender uses, whether you're looking for a credit card or an auto loan, a mortgage, personal loan, any type of debt. No lenders use the Vantage score at this point. And where the Vantage score can get you into trouble is it's not, the algorithm itself does not function like the FICO algorithm that we saw at the beginning of this webinar. The algorithm itself discounts certain information. It discounts things like medical collections or paid collection accounts, and it disproportionately will discount late payment history that has aged in a way that's different than the FICO algorithm. So someone can get a false sense of security in thinking their credit score is anywhere from 50 points, and even I've seen in cases 100 points higher, because they're looking at a Vantage score rather than the FICO score. And then point number 3, when I say free does not really mean free. What I mean is, no, that service that they're providing to you of giving you that Vantage credit score is in exchange for them being able to take your data and sell it. So really, what are they doing when they sell the data? They're giving that data to companies that pay for it. So if I am a credit card company and I want these particular characteristics of a consumer to try to sell my brand new secured credit card to, or my credit card that rewards people that travel, or whatever it is, I can go to Credit Karma and I can pay them a fee and ask them to send me information on all of these people that meet these data points. And then from there, I can put ads on the different websites you view, right? Facebook or wherever you're viewing. I can send you targeted letters in the mail, pre-qualified for this credit card, apply today. I can send you emails. I can do pop-ups in your Credit Karma app, and they'll keep sending this information to you over and over until you finally make that purchase. And the reason they want to do that is Credit Karma gives them access to so much information that their rate of conversion is higher than any other platform out there as far as that's doing targeted advertising. It's pretty crazy. So free isn't really free to you. It's free in the way that they're selling your data, and advertisers are essentially the ones that are paying Credit Karma and those types of platforms. So if you are looking for somewhere to obtain your actual credit score, your FICO score, there are many services out there, but they are not free. Your FICO score is not something that you can obtain free. Many people have heard of getting your free annual credit report. So you can go to annualcreditreport.com for that. So they will give you your full credit report, but they won't give you your scores. So keep that in mind. If you do want your actual FICO credit scores, the way you can obtain it is through, I'll send out a link in the chat later or after this webinar, how about with My Score IQ. That's the service that we use with our clients that gives the FICO score. There's some other services out there as well that you can use. The annual score, you can't, to answer your question, there is no way to get a free annual score, just your annual report. So you can go to the annualcreditreport.com and get the information on your report, but not the actual score itself for free, unfortunately. So, oh, and then one of the other things I was going to say, I wanted to also mention this. Another misconception, and I'm kind of swaying off topic here, but I do think this is important to be aware of, is when it comes to your FICO credit score, there are actually 9 different algorithms. So you may notice if you ever get your credit report pulled by some sort of a lender, credit card company, or you search for your own credit report online, credit score, excuse me, you'll see a number next to it. It might say FICO 8 or FICO 2, FICO 4. When you apply for credit, different institutions, different financial institutions might use different versions of FICO. When you go for a mortgage, they use versions 2, 4, and 5. So on one bureau, they pull version 2, on another bureau, version 4, on another bureau, version 5. So this often confuses people because let's say you go and you pull your FICO scores directly from, you can go to Experian and pay for a score. You can go to Equifax, pay for a score, and TransUnion, pay for a score. If you pay for it, they'll give you a list of all of your scores, right? And they're all going to be different because they're all different different versions of FICO. So I'm going to go back here. Let's see if let me go back here. That's okay. And it's still that same 35% for payment history, 30% for utilization, et cetera. But the way it looks at some of that information is different, right? So with the older versions of FICO, late payment history isn't time weighted, meaning as it gets older, it's not less impactful. Where with newer versions of FICO, if you had a late payment 4 years ago, it doesn't impact the score as negatively as if you had a late payment in the last year, for example. So you'll never necessarily see the exact same FICO score across every loan or credit application that you do. But it's important if you understand that general mix, the focus on payment history, the focus on credit utilization, all of the scores can be higher. They can be in that higher category. Okay. Any questions there? Because that can get quite confusing. I know it can. Okay. Well, we'll go ahead and move on. And at the end, we'll have some time for open Q&A as well regarding anything credit related. So the next myth, paying collections raises my credit score, right? I would say this is one of the myths that I see the most on floating around on the internet. So when you pay a collection account, it will show up on your credit report as paid in full or settled. It's not going to remove the account from your credit. And that's so very important because the account being paid will not increase your credit score. Yes, I will speak on the pay and deletes here in a moment. Yes, I definitely can do that. So With a Vantage credit scoring system, if you pay your collection, you will see your credit score increase. Because remember, that's one of the things I had mentioned, that algorithm functions differently. So it's really important, in my opinion, to focus more on your FICO score and not be swayed incorrectly by using Vantage scoring software. So when you pay a collection, in some cases, it can actually damage your credit score even further, because what it's doing is it's creating a new, more recent activity on your credit report. And that's a new delinquent activity. It's a delinquent payment, right? Because that account is already in a negative status. And a collection can be worth up to 110 points. So to explain that further, if you are somebody who has no history of any negative information on your report at all, and you get one brand new collection, let's say it's Comcast, that could drop your score up to that 110 points because it's so abnormal to your credit behavior. Now the credit algorithm is, red lights flashing. Oh my goodness, risk, risk, risk. This is so outside of that person's norm. They must be having some sort of a financial hardship. We must be sensing a high risk situation here. But for somebody who may already have a history of having negative information on their credit report, that new collection will be proportionately worth less. It will still have a higher point value than older accounts or older collections on your report, but it's not going to be worth 110 points. It'll proportionately be worth less. So let's go back to the question that you had about pay for delete when you have a collection. The best and only way to help your credit score when it comes to a collection is to get it removed from your credit report. So how do we do that? Option number one is a pay for delete. So, or two, I know, whatever way you want to put it. In our case, when we work with our clients, pay for delete is our absolute last resort. But if you are going to go that route, you can talk with the collection company and negotiate a payment in exchange for them removing that account from your credit report. This may be a settlement for less, or this may be for the entire amount that they're claiming that you owe. What's extremely important when you take this action is that you get it in writing that they will remove it from your credit report. Unfortunately, collection companies lie. They're not supposed to, but they do. They do. They're one of the least regulated financial industries still. So while they do have laws and regulations, they're not heavily audited, and most of the auditing falls on you as a consumer. And that's why companies like ours exist, because it's up to you to make sure that your rights are being maintained, and often they're not. So that takes me to why we don't do a pay for delete first. We don't do a pay for delete first, again, because most often these collection companies are not operating on fully legal grounds. Not to say every collection company does things wrong, because they don't, but a large majority do. A large majority will purchase debt, and they won't ask for proof of that debt. They're just buying debt pennies on the dollar, and they're doing their darndest to call you, collect on it, not looking to make sure it's not past the statute of limitations for them to collect, not looking at whether or not they truly can sue you or not for that debt. And the list goes on and on, right? Maybe they're calling and harassing you, calling outside of hours they're legally not able to call outside of. So the process that we employ with our clients, and I would encourage you to employ, is the validation process. So it is making sure that they can prove that that debt is valid. I will say there's quite a bit of confusion on the consumer side as to what qualifies for debt validation, and it's spelled out differently for different types of debt. And I'll segue into a misconception that is all over the internet, specific to medical debt. It is not a HIPAA violation for a collector to provide you proof of a medical debt. And I will repeat that. It is not a HIPAA violation. That I see all over the internet. There is a certain contract that is put in place, and I think a certification, I'm not coming up with the right word, nonetheless, certain companies are entitled to collect on medical debt. Do they still have to prove you owe that debt? Absolutely. But them providing that validation itself is not a violation or a reason that you can get a medical debt taken off your credit report. What is very common, or a very common reason you can get a medical debt taken off your credit report is billing errors. Maybe they didn't bill your insurance when they should have. Maybe you already paid for that procedure, and they're trying to come after you for something that you already paid for. So there's all sorts of things. To be fair, we could talk about just collections in an entire webinar in and of itself. Now, medical collections as well often won't show the original, like the collection company on your credit report or the original doctor's office. That's something that's important. But I encourage you, if you're in a situation where you have quite a few collections on your report, it's important to get the opinion of a professional. And that's simply because you don't want to end up in a situation where you're paying something you legally don't have to, just by not understanding the intricacies of the law, because there's a lot of pages in the Fair Credit Reporting Act, hundreds and hundreds, that you can use to fight to get things off your report. So our clients, most often, we can get almost every collection off their report without a payment being made. And then sometimes we do suggest they make payment, but it's important to understand the law. Now, your other question was, should you let the collector take payments from your bank account? I don't suggest doing this. Now, the reason for this is if it's a third-party collector and you give them access to your bank account, there's the chance that in the future, if you have a new collection from them, they may use that information to try to pull that payment again or pull a new payment. Is that legal? Absolutely not. Is it possible? Yes. It's happened quite a bit in the past. I can say it's not something that happens as commonly anymore, but it's definitely still possible. If you encounter a situation like that, consult an attorney right away. You can be awarded damages when they are violating different pieces of the law, whether it's the Fair Credit Reporting Act or Fair Debt Collections Practices Act. And again, collections, we could talk about your rights on that in an entirely another webinar. And, we may do something like that in the future because it's a pretty common topic. So last point I will make on collections is understanding the statute of limitations for legal action. So statute of limitations for legal action, what's that mean? That means can they come after you for garnishment? Can they come after you and file a judgment? So that statute is different for different states, or that timeline for the statute, excuse me, is different depending on the state you're in. It's different depending on the type of debt as well. So again, you're going to want to make sure you really understand the law when it comes to collections. There's a massive amount of information that you should be aware of there. And if it's something you're having trouble sifting through on your credit report, we're happy to look at that for you too. Okay, so let's go on to the next myth. I hear this one quite a bit with any of our clients and just really anyone in general. I need to use my credit card monthly to raise my credit score. So this information probably gets out there from credit card companies, right? Credit card issuers want you to use your credit card monthly because what happens if we use our credit card? Well, if we forget to pay it, then we have a late fee. And then we have interest on top of that. What if we go over limit? Then there's more fees that can be assessed. So credit card companies, they want you using your card as much as possible, right? That's how they get paid. They don't want someone who doesn't carry a balance or who uses their card and pays it off monthly. What's important to know is you definitely do not have to use your credit card every single month to see your credit score increase. In fact, when we have clients that we're working with on rebuilding or reestablishing credit, if we have them open a secured credit card, we tell them not to use it because it's still going to report as an on-time payment every single month. It's an open account. It's an open line of credit. Whether you owe $0, whether you owe $10, it is considered an on-time payment and adds to that payment history category of your credit report. Again, that biggest overall factor. It is so important to make sure you have a credit card. I'll reiterate that again. But if you don't trust yourself with the ability of not charging too much, don't use it. If you're worried about keeping it active, if it's a secured credit card, they usually have an annual fee. Those aren't going to close. If it's not a secured credit card, use it once every 3 to 6 months. Some credit card companies require it to be used once every 3 months, some once every 6 months in order to keep it active. But really all you want to do is just make sure it's there, make sure it's, a low utilization ratio. So it's helping that utilization, that 30% of your score. And then again, with the payment history, that's 35%. So that's 65% of your score right there. So again, using your card once every 3 months is sufficient. I think I covered everything here. Oh, one of the other things I wanted to bring up is oftentimes people may see their credit scores yo-yoing, meaning it is going up and down based on the balance, right? So if you are someone who does use your credit card every month and then pays it and then continues to pay it down, the credit card balance that's reported is going to be dependent on whatever day that the company sends the information. So it's not dependent on your due date, right? If your due date's the 5th, but your credit card company reports your balance on the 20th of each month, doesn't matter what your balance was on the 5th, that it was 0. If on the 20th it was, 80% of your credit limit, that's what the bureau is going to see. So you may be wondering, well, how do I know when my credit card company is reporting my balance? You can see that on your credit report in the section labeled last reported. So that's something you'll see, and that date may be different for each credit bureau. So that's something to keep in mind. It may be something that is not consistent, which is why it's so important just to make sure you don't use a high percentage of your credit limit, regardless of the time of the month or the purchase. Try to use 25% or less of your limit at any point. If your credit limit is low, then that would mean about every 6 months, as long as you have excellent payment history on your account, request a credit limit increase. And if you are someone who has maintained a low balance, your credit card company is likely to automatically give you increases because, again, back to this top point, your credit card issuer wants you to be causing them to have to assess you fees and interest. And the higher your credit limit, the more likely you are to use too much of your credit card, which means they will in turn get paid. So I guess what I'm trying to say is we have to, instead of thinking like the consumer, we have to think like the credit card companies. Their goal is to make money off of you, but how can we use the way they're structured to your advantage? And hopefully this gave you a little bit of insight there. Okay, next. Alrighty, inquiries are severely damaging to my credit score, right? Okay, so this one comes up quite a bit as well. I think there's a lot of fear around inquiries because people are so concerned that if I apply for credit, is it going to ruin my chance that I can get future credit if I'm denied this time, or if the terms aren't good enough and so I don't want that new loan or what have you. The good news is, because inquiries are only in that 10% category of that credit score algorithm, they don't have a severely large impact to your score. An inquiry itself is worth about 1 to 5 points on average. And if you're someone with a robust credit file, a person who has a long credit history, a lot of accounts on your report, you're probably closer to that 1 point category. If you're someone who has a thinner credit file, you're probably closer to that 5 point category. But I have some good news still. You can still have 4 inquiries per credit bureau per year with no negative impact. Unlike other information on your credit report, inquiries only stay on your credit report for 2 years. So whereas, to give you a contrast, negative information stays on your credit report for 7 years, and positive accounts stay on your credit report for 10 years. So inquiries are only 2 years, and inquiries can come in 2 forms, a soft inquiry and a hard inquiry. So a soft inquiry has absolutely no impact to your credit score. They come from things like rental applications, or when you're looking, let's say, for new renter's insurance or car insurance, or things like applying for new utilities. Let's say you moved recently. And a hard inquiry, like I said, minimal impact to your score, remains on your report for the 2 years as well. And it only applies to applications for credit or a new debt. Oh, shopping around. I did want to mention shopping around. So you may have noticed, if you've shopped for a car loan before and you went to the dealership and they pulled your credit, all of a sudden you may have noticed 20 inquiries on your credit report, a huge number of inquiries on your credit report, because they went to each and every financer that they work with to see what is the best auto loan terms they could get you. When they are doing that, please know it's called shopping around, and it is considered one credit hit, so one inquiry, even though you're seeing a massive amount of inquiries on your credit report. So it acts as if it was one inquiry. So if you're already above that 4 inquiries per bureau per year, it's only going to hit you that minimal 1 to 5 points. Now, let's say you applied for an auto loan in January, and then you go to apply for an auto loan again in March. That's going to be considered a separate instance. So that would be inquiry number 2. But if you go to multiple different dealerships within the same 30-day time frame, it's all considered shopping around. The same is going to be for a mortgage. Let's say you're shopping around for at different lenders, all within the same 30 days. That is only going to be considered one inquiry. What is not considered shopping around is credit cards. So it does, with any credit cards, it does not matter whether you apply for 2 different credit cards in the same day. It's always going to count as a separate inquiry. So just know that credit cards do not function that way. The only types of debt, that fall into the shopping around category are going to be mortgages, student loans, so private student loans, and then auto loans. So again, if you need debt, don't be afraid of an inquiry. It is your responsibility to make sure that you get the best loan terms and the best loan options for you, because that's an obligation that you are bound to. So if it means a hit of 1 to 5 points on your credit score, take that any day over getting a horrible loan. Okay, it looks like we have another question. Okay, question about opening new credit while house hunting. So when you're, hopefully this will answer you, and please let me know if it doesn't, and I'll be happy to answer in a better way. So when you are house hunting and a lender sees new credit applications, what's going to happen is if you do open new credit, they're going to have you write a letter of explanation, which really just means, why did you apply for that new credit, right? If you got a new loan, let's say you got an auto loan, you needed a new car, your current car, you had no loan on, no payment, and you got a new auto loan. Now they have to consider that into your debt to income ratio, which just really means, what are your monthly bills, your monthly obligations? When you get a mortgage, you have a debt to income ratio requirement. So if that new auto loan now puts you above the threshold for debt to income, you now may no longer qualify for a loan, or alternatively, you may qualify for a smaller purchase price or a lesser purchase price. So the reason you often hear don't take out new debt when you're shopping for a mortgage is because of that. They don't want you to take any actions that are now going to disqualify you from that mortgage opportunity. Opposingly, let's say you have an auto loan and you refinance it. Let's say you were at 15% for your auto loan interest rate previously because you had poor credit when you first took out that auto loan, and you've worked really hard and you've improved your credit score, and you find out that now you can qualify for an auto loan at 4%. If you refinance that debt and you now have a lower payment and you didn't take out more, you just, exact same auto loan, just refinance the amount you already owed, and you get a lower payment, that's likely to help your debt to income ratio. So in that situation, you're still going to have to put together a letter of explanation that just says, hey, I took out a new auto loan, I refinanced, paid off my last auto loan. This is why. Here's my new obligation. You may have to provide a bit of a paper trail. So is it cumbersome for the loan officer when that happens? Absolutely. But did you put yourself in a better financial situation that now may make you qualify better? That's a horrible way of saying it, but have a better qualification for that mortgage? Yes. Should you be talking to your lender before doing that? Yes. We do not ever want to blindside a lender. But I hope that answers your question and gives you the rationale behind why you hear don't apply for new credit in the midst of the mortgage process. If that doesn't answer your question, let me know if there's any clarification I can give. Okay. Credit cards, yeah, that's the same. I mean, same for credit cards too. So credit cards, if you open a new credit card, like I'll give you an example. We specifically work with clients who have a goal of home ownership. And oftentimes as part of the credit rebuilding process, we will advise our clients to open a credit card, especially if they don't have credit cards. So when we do so, again, we always say, don't use that card, keep that card at a zero balance. And the goal, of course, is to increase the credit score. So if you're opening a new credit card and you're not using it, it doesn't factor into the debt to income ratio because there's no payment obligation. But it is going to require you to write a letter of explanation. They may also require some sort of documentation to prove your balance if it's a brand new account from that creditor. So just keep in mind that it can complicate things. It certainly can. But if we're not adding to your debt to income ratio, it shouldn't disqualify you from the mortgage. But if you're running on a crunch timeline with a sales contract, you don't want to be making all these new actions or new activity. It's something you want to do typically before you start the process, not in the middle of the loan process. But they'll ask about any new debt within 3 months of getting the mortgage. So sometimes 6 months, it depends on the lender's requirements, but they are always going to ask about new debt or new accounts that have been opened. And that's all I had for inquiries. Okay, so that concludes the myths, the most common myths that we come across. And if you have questions about your own credit report, we always offer free consultations, free reviews of your credit report. We'll walk you through each line or each trade line by line and go through any of the questions you have regarding the account, how it fits into the credit reporting laws and all of that. But I want to open up the floor for any questions. And again, feel free to type in the chat or feel free to unmute yourself if you just want to ask the question directly. And I'm happy to go through any additional questions you have, whether it's about myths or something else credit related.
I've always heard that you don't want to keep more than 30% on your credit card balance because something about that 30% is, big at keeping your score higher. I don't really know how to say that correctly.
That's okay. That's okay. Yeah. So when it comes to your credit the credit algorithm, let me go ahead and I'm going to go back to see if I can get this. There we go. I'm going to go back here to the algorithm and we'll take a look at that. Oops, went back to the beginning. One more. There we go. So where it's factoring in is the utilization ratio, right? That 30% of your credit score. The reason I would say 25%. In a very perfect world, try not to use more than 8% of your credit limit. But is that realistic for most? Absolutely not. That's going to be more realistic for someone who has a really high credit limit on their credit cards. But the reason you hear that number, whether it's 20%, 30%, 25%, is because of the yo-yoing that can be created, or the volatility that it can create in your credit score. If you're going to 80% utilization, you might see a big score drop. And then once you pay it off, your score is going to jump back up. So it's something that can be hearing keeping utilization low is so you don't see volatility in your credit score, because it is such a large percentage of what makes your credit score. Does that make sense?
Okay. Yes, and then kind of second to that, if you're if you're using your credit card all the time, and then you're paying it off, like say I use my credit card all week long and then I pay it off at the end of the week, but does that help too, or should it only be paid at the time it's due?
So you can pay it, in short, it doesn't, I mean, you can pay it either once a month or every week like you're doing. What you're really trying to do is you're trying to play the game of when that creditor is going to report your balance to the bureau. So if you're always paying it off before they report your balance to the bureau, you're going to show low utilization. But if you charged your card, let's say, up to 80%, and that happens to be the day they report balances to the bureau, because they only report the balance for most credit cards once a month, then all of a sudden, because that was the day that month that they reported, and you were at 80% just for that single day, you're going to have 80% utilization that day, or that month, excuse me, on your credit report. But the following month, you know, if it doesn't line up that same way and it's zero, you'll be back at zero. And that's why I suggest to ask for credit limit increases, so you don't run into that issue. If you know, hey, I always charge $1,000 every month on the credit card, I always pay it off, but I always charge $1,000. Try to keep getting your credit limit increased, so it doesn't matter that you're charging what day they're reporting, right? No matter what, you're always under that threshold, and you're not going to see your score yo-yoing. But better yet, if you are getting ready for a home purchase or any sort of big purchase where it's super credit score reliant, don't use that credit card a couple months leading into it, so you don't have to worry about the timing. No matter what, you're going to have the best score possible showing when they pull your credit. That's a suggestion that I make to most people.
Okay, and then my very last question would be, so what if on the day that they pull it, you actually have like a negative balance, right? So say like I've paid off what I did for that week, and then it's showing that I have like not a negative balance, excuse me, like a credit.
Like a credit.
On does that negatively impact?
No, it doesn't negatively impact it. It'll just be 0% utilization, so that'll be good.
Okay.
Yeah. And then we had another question. If you pay off all debt, will your credit score drop to 0? No, it will not drop to 0. Now, eventually, and that's the short answer. The long answer, or the start of the long answer, is it's complicated. So as accounts age, they become less and less impactful if they're closed, right? And eventually, if you don't have enough information on your report, you won't have a score. And it's not even 0, it's just no score, no score provided. It's an error code if they try to pull your credit report. So similarly, if you're someone, let's say you have no open accounts, but you have a couple of collections on your report, you may also have no score. You might not have like a 400 or a 300 or a 500, you might just have no score reported because there's no open activity, no open accounts. Having an open account factors into so many of these categories here on the screen that you see for the algorithm, that if there's not enough open accounts, it just might not create a score. But when you first close everything, you'll still have a score for a while. It's still recent enough history to create a score. Hopefully that answers your question. What other questions do you have? And I'm happy to go into anything else. Okay. Well, if there are no other general questions, then we will go ahead and conclude for today. If you are someone who wants to learn more about how we may be able to help you adding positive history to your credit report with credit building planning, or if you have negative information, you're trying to figure out how to clear it up, don't hesitate to reach out to us. You'll have our contact information here at the conclusion of the webinar. We'll go ahead and we send out an email to everyone. But other than that, absolute pleasure getting to chat with you all tonight. And stay tuned for some more webinars in the future about other credit topics. Thanks, everyone.